Hello my fellow freedom builders and welcome back to the channel. Today I'm going to give a little update on the US economy and the US dollar as a reserve currency. I've made a couple of videos about that before, but today I'll give you a little update as to how I see the state of the economy and the dollar. First of all, before I go any further, then please remember that since I am closing in on 5,000 YouTube subscribers, I am every 2 weeks actually picking winners for some 1 ounce silver coins that I will give free and clear to you as a giveaway, and I'll do that for, I don't know, some months or something like that. Every 2 weeks, the only thing you have to do is to comment in the comment section below. Remember to like and subscribe and all that, but comment in the comment section below and make sure that I can find you via your email or something like that, so I can send the prize if you are the winner. Alright, let's get to the topic for today. If you remember from my first videos, I was talking about the US dollar that might be in trouble. And one of the reasons was that they were taking on too much debt, etc, etc. I was talking about the US dollar being a reserve currency of the world and what that meant for United States, what privileges they got from that. I also mentioned that around every 100th year, the reserve currency status, it wasn't called that back in the 1600s, but this main currency, dominant currency status, tends to shift about every 80 to 110 years. And right now, the US dollar has been the world's reserve currency for the last 100 years. I got a lot of comments after the last video saying something like, yeah, well, there's not really any currency to replace the US dollar right now. And that is true, but neither did people think that there were anything to replace the British pound here when they stopped, and people couldn't see what should replace the French currency here back in the 1800s. So that is not really a valid argument saying that we cannot see what can replace this, because if anyone could see that, or if everyone could see that, then it would be an easy shift. But that is often a very turbulent period when we shift reserve currencies, so we have to be careful of that. Also, in this video, I talk a lot about the petrodollar and US debt and so on, and I'll put a link to this, the first 2 videos in the text section below, so you can go back and watch that if you're interested in that. But let's have a look at some of the topics I will talk about today, because I am going to talk about a topic called stagflation. And as you know, right now we are in a crisis situation, partially due to the virus and all the turmoil created by that, but also because we were at the end of a larger financial cycle and the economy had started to slow down, and then came along a virus and triggered a really bad downturn and a worldwide recession. Now, what I'm going to talk to you about today is this stagflation concept, because when we talk about stagflation, we are talking about a situation where the inflation rate is high, where the economic growth rate slows, and the unemployment rate remains steadily high. And I'll have a look at if we are actually in a situation where we are getting closer to stagflation. Stagflation is a rather rare occurrence, because it is a bit of there are a lot of complex things that has to go together in the same direction here in a really bad way. But we might be heading in that direction. So let's have a look at it. So remember, we are talking about inflation, we are talking about economic growth, and we are talking about unemployment. First of all, let me take the economy part, because not many people are doubting that the economy right now is in a bad place. We can see here, and this is from Trading Economics, a very good site. You can see here that the GDP growth is on a minus 32.9%. That is the worst, I think, ever, or at least since back in the 1920s. And that is really bad, and has put a stop to a lot of economic incentives in the entire world and in the United States, of course. Now, what many argue is that we are gonna see a V-shaped recovery. We are gonna jump right back because this is just a little bump on the road, this virus. Not a little maybe, but it is a bump on the road, but we will soon be back in full speed. Now, they might say that, but when we look at what the CBO says, and that is the Congressional Budget Office, that is the Congress in United States, they have this budget office that are very much in depth with the economy. And what they say is that recovery for the US economy will take about 10 years. Of course, we will not be hanging down here at minus 32% for 10 years, but it will take at least 10 years before we are back to normal. So I don't know about the V-shape. Of course, we can see it in the stock market, but I'm not talking about the stock market here. The stock market might be going up for the next 10 years. I don't know. At least as long as the Fed keeps printing money and buying up debt and there is some sort of trust in the US system, then the stock market might be going up almost forever. So don't hear me saying that the economy is the same as the stock market, because it is clearly, or it is clear to everyone, that the stock market and the overall economy are two completely different things, at least right now. So as I said, the CBO says that there are some very long outlook to, you can see here saying the US economy won't recover until 2029. And the recovery won't begin until next year, that is 2021. So then it'll be a slow and steady climb for the next 8 to 10 years upwards. That's what they are saying. All right, what I have been saying for a while is that I've been looking a lot at the retail sales and at the personal spending in the United States, because that is where we might see some of the signs of either things getting better or getting worse. Now, for instance, we have Nordstrom. I know they are a bit at the higher end of the retail sector here, but they saw the last quarter, they saw sales plummet 53%, facing a net loss of $255 million. And I know this is part of why the Fed is printing money and why they're buying up debt, because of course they don't want big chains like this to close for business. But what we can see in the United States is actually that a lot of the, especially smaller businesses that have closed temporarily here during the crisis, they simply don't open again. And when we saw the unemployment numbers, I'll get back to that in a second, but we actually saw the initial jobless claims going up last week for the first time. People thought that it would be going down, but actually more people registered as unemployed for the first time last week than they had done for a couple of weeks. The number had been going down, but now it went up. And today, actually, we'll see if that was just a single occurrence, an outlier, or if it will keep going up. But right now, we can actually see that retail sales, at least in some sectors and some areas, and that is going down. Now, what we can also see is that Fed seen holding rates at 0 for 5 years in new policy. Now, when Fed is holding the interest rate at 0, or they might even go into negative, even though they say they won't, but if they are holding this at 0 for 5 years, it means that they acknowledge how bad things look. And just the other day at the FOMC meeting, when you read the transcript of what Jerome Powell actually said, he said that Fed had thought we were to see a V-shaped recovery, but they were a bit surprised and they could see that things were going slower than expected. So he kind of indirectly said that the V-shaped recovery is maybe not dead, but at least it'll be a bit more of a U-shape. Now, this about the shape of the recovery is a funny thing, because in the beginning, everybody talked about the V-shape. Now, then they started talking about the U-shape, meaning that the bottom was a bit longer, and then we would be moving up. Some people were talking about an L-shaped recovery where we would just go down and stay down. And as I'm going to mention today, we actually have a new letter now where we are talking about a K-shaped recovery. I get back to that in a second. But what we can see right now, with the overall, with the Congressional Budget Office, with the Fed and so on, they are saying the economy is not great and it is not gonna get back to normal the next many years. Now, when talking about the stagflation, we have the economy, then we have unemployment. Now, unemployment rate is, the unemployment rate has been going down, at least officially. But as you might recall, I made a video about this. The official unemployment number is actually completely false. And it is not because I am touting some conspiracy theory here. It is simply because that the official unemployment rate, also called the U3 unemployment rate, they are not counting, for instance, if you have been driving 1 hour as an Uber driver, or if you walked the neighbor's dog for 1 hour last week. If you have had some sort of payment from some sort of job for the last 4 weeks, then you are not counted in the unemployment statistics. Also, if you're working in an area, let's say you are in an area where it is all steel manufacturing companies, and that is all you've been doing for the last 40 years, and now all the businesses are closed, and you have simply given up finding a job that you are qualified for, so you haven't been looking actively for a job for the last 4 weeks, then you are also kicked out of the statistics for the U3. So what I'm looking at, or we can take a look at the U3 here, it has been dropping to something like 10.2, and that is absolutely ridiculous. It is way higher, but 10.2 is where the official rate is. That is extremely high. Now, looking at the U6 here, we can see that that is actually at 16.5%. That is almost 1 in 5 Americans on the job market that is without a work. And this number is actually also a bit higher because the office calculating it has admitted that they have made a counting error for 3 or 4 months in a row here in the spring. So they are writing in their own report that this can actually easily be 2 to 4% higher than the official number here. So we are talking about a bad economy. We're talking about high unemployment. Now, to have real stagflation, we need a high inflation. So we have a bad economy, a real bad unemployment, and then a high inflation. And what we have seen in the official numbers lately is actually that, and that is also what many economists have expected, is we are going to see some move towards deflation. Now, normally we are used to the goods we buy, they get a bit more expensive each and every year. And that is why we buy now, because I'm buying the car now because I know it might be a bit more expensive next year. For many years in Japan, for instance, they have had deflation, meaning that people are not spending money. Because if you have a deflation in a country of, let's just say 10%, it is not 10%, but just in round numbers. So if you're looking to buy a car at $50,000, and you know there is a deflation of 10%, that means that you are holding on to your money because you know that you can buy 10% lower in a year. Just theoretically here. Of course, it's not 10%, but just to give you the picture. So the politicians, the economists, they really, really don't want a country to move into deflation, but they also don't want the inflation to be too high. And there are some reasons for that I'll tell you just in a second. Now, the unemployment here was high, we can see that, and actually they even have there were some estimates here. This is the unemployment rate and the poverty rate in the United States from February. That was the estimates, but as you can see here, if the unemployment rate is high, and let's say it's just up a bit around the 20% here, the U6, it means that we have a poverty rate the same as back in the 60s and 70s, extremely high, meaning not much personal consumption, meaning a lot of retail businesses in trouble and so on. It is a really bad circle here. Here we can see this K-shaped recovery. It seems like people that are making up around $80,000 to $100,000 per year in the United States, they are mostly safe. They are going up in safe area here, but everyone else is going down, and there's a lot of statistics there. Now back to the inflation. Now There are a lot of videos on the internet, and I might actually make one myself about the inflation concept in United States and actually in many places in the world. Because what has happened is that over the last 30, 40, 50 years, the way that the governments and the economists are calculating the inflation, the CPI here, consumer inflation, has changed quite a lot. And in the old days, it was they took a basket of goods and they saw what are they costing this year, maybe $100. Now, if they could take the same basket of goods with the same brands and everything, and next year the goods would cost $105, then they would say, and this is just very simply explained, but then they would say that the inflation was 5%. The goods had gone up from 100 to 105, so your money was worth 5% less. But today it is extremely complex the way they calculate it, and they're not just looking at the same goods. They are, if they can see that a certain product has gone up 20% in a year, they're trying to replace it with something that they think is kind of the same, meaning that they can actually manipulate it in any way they want to. And here on the website, ShadowStat, Shadow Government Statistics, run by John Williams. I know some people are very critical about him, but he is an economist, and as far as I can see, these numbers are fairly well calculated, because what we can see here is that the official CPI, the official consumer inflation, is very low in the United States. But the way they calculate it has changed quite a lot, and the blue line here is if you calculate it the same way as you did in 1990, before many of the changes happened. And if that is true, then we actually see an inflation in the United States right now up around 5%. Now, why are the government not interested in an inflation of 5%? Well, first of all, if the money is getting 5% less worth each and every year, then every bank and financial institution that is lending money out, they would say, well, we want at least 5% in interest, because that is just what the money is getting devalued every single year. And then we would need something to make money on. So they might rise, if they actually had an inflation of 5%, they might rise the interest rate up above 5%, maybe 7%. Now, we all know that in this debt scenario we are in right now, an interest rate on 7% would pretty much kill 90% of all companies in the United States. It would pretty much also kill the United States, because they would also have to pay that debt. And right now, with the debt level they are on, that would be end of business for United States, as far as I can tell it. So that is one thing. That is the interest for privates and for the government and for businesses. But there's also the thing that a lot of the United States costs are based on the inflation rate. So for instance, the money you get if you are retired, if the inflation rate is 1%, then that amount goes up 1% per year. But if the real inflation was actually 4 or 5 or 6%, then this payment to retirement would have to go up with the same amount. And that would simply kill this box of money that is allocated to this in the United States. There's no way that it can pay this much money extra every year. They have problems enough as it is today. So this is an exciting site. The thing is that if we're actually looking at it and we are saying the economy is bad right now and is going to stay bad for a while, the unemployment is high and will stay high for quite a while, and let's say that they're right about the inflation actually being high, then we are close to a scenario with stagflation. And stagflation is one of the worst places an economy can be, because it is so extremely hard to get out of it. And several economists have done some theories about this, but it is a bit hard to theorize about, because it happens so rarely that it is hard to get some good valid stats on it. But this is how it is, and this is one of the reasons why I am fairly negative on the long-term view for the United States. And this is just a part of it, because I have one little angle extra for today, and then I'll finish quickly. And that is because I started talking about this potential crash in the US dollar. And as I mentioned in my first videos, we were talking about the reserve, their status as being a reserve currency, and we were also talking about the petrodollar. And a lot of the reason why the United States or US dollar is very high today is because, of course, there is a lot of demand for the dollar. But what if that demand were to go down? And let's say, for instance, that we have here from the site oilprice.com, and I know this article is written by something called safehaven.com, so they are maybe a bit biased towards, gold or all sorts of safe haven investments. But they have a long article here that is actually quite well written about the US dollar is losing its position as a reserve currency. Now, I don't think they're losing it right now. But as I said in my first videos, one of the reasons why I'm a bit worried about this is that a lot of people, for instance in Denmark where I live, they see United States and the United States stock market as a place to put money for instance, long-term dividend investment. And it is fair enough, and you get 3 or 4% each and every year in dividends. Let's say you do that. But what if in 30 or 40 years that United States status as reserve currency is gone? Then you might see the US dollar drop 80%, and a lot of the money you thought you had for some times where you get older are pretty much worth nothing, or at least a lot less than you thought. So this is one of the reasons why I'm talking about this, is because people are seeing the United States and the US dollar as a thing that never changes. But history tells us that these things change, and they also change in ways and at times where we thought they were completely secure. So right now, a lot of things going on. And as I said in my first videos, the things that keep a country as a reserve currency is trust in the country, in the political system, and it is a sane economy, and an economy without too many fiscal deficits. And right now, United States is on the wrong path in both areas. They are running a completely insane economy, printing money left and right, and having a huge deficit. They did have that before the crisis, so that is not new. And it is not just Trump, even though I'm not a fan of him. We cannot blame him solely for that, because it has been a long path to that. However, before he became president, he was very hard on the economic side and said he wanted to balance the budget within the first 4 years. So I guess that is not anywhere near happening right now. But also, there need to be trust in a country, and that they are run in a sane way, and that they honor their international obligations. And we must say that under Trump, the last 4 years, that has not exactly gone in the right direction. They have withdrawn from pretty much every single agreement they have entered, the Paris Agreement and the Iran deal, the nuclear deal, and they are threatening to leave the WTO, and they are partially withdrawing from the WHO here in the middle of the virus crisis and so on. So a lot of trust have been lost here, and that is one thing that could accelerate this losing the position as reserve currency. We can also see that China and Russia, and they are very interested, believe me, in dethroning the US dollar. And I'm not saying that this is good. I'm not saying I'm hoping for this, because I think that the second it happens, the whole situation in the world will be a lot worse. But China and Russia, they're ditching the dollar in a move towards financial alliance. So for the first time, their trade together is below 50% in US dollar, meaning that normally they have been using US dollars to trade between the two countries. But right now, that has been dropping, and it's getting lower and lower. And they have also they have gotten rid of a lot of the dollars they had in reserve, so that have been sold back. They have been buying gold instead. So China and Russia are very eager to dethrone the US dollar, and also to destroy the petrodollar. We can also see that Russia calls on fellow BRICS countries to dump US dollar in favor of trade in national currencies. So they are also saying and this is of course Brazil, Russia, India, China, and South Africa, that is the BRICS countries. They are doing something like 21 trillion, I think it is, $21 trillion per year in GDP, and they have more than 40% of the world's population, these countries. And I'm not sure that Russia can just say to them, hey, now we don't want to use US dollars anymore, but they are working on it behind the scene, and right now they see United States as a very weak country, and therefore they are using this vacuum to try and manipulate the other countries into using less dollars. And something could show that they actually have at least partially a success with this. So the conclusion here, or at least maybe I should say that here in 2020 in July, Fitch Ratings, there's one of the big ratings companies, they kept the United States on their AAA rating, but revised their outlook from stable to negative. Fitch noted that the US benefited from issuing debt in the world's reserve currency, but highlighted that the US government had the highest debt of any AAA rated sovereign, and there was no credible fiscal consolidation plan in light of the economic shock caused by the virus. So what they're saying is that United States are printing money left and right, and that can help them in the short run, but there's no credible fiscal consolidation plan. They simply don't have a plan. They don't see how they can get out of this. And that is one of the reasons why I am very skeptical on the long-term stability of the United States. Of course, we have an election here in a couple of months, and a lot of speculation as to what if Trump wins, what if Biden wins. I'll not try and be clever and guess here. It'll all be guesses who will be best. Many people are talking about who will be best for the stock market. I'm actually more concerned of who will be best for the long-term economic growth of the United States. I really would like the United States to keep being this economic superpower, because it helps the entire world, or at least the part of the world I live in, into getting into a more stable phase. So what I'm saying is that you need to be careful on the long term. Now, I have my own little investment company, and what we do there is that we hedge ourselves right now so that we are neutral on the dollar. We are paying a bit of insurance simply to be neutral on the dollar. We're doing that a quarter at a time, in a way so that if the dollar should crash 10 or 20 or 30%, which has happened before over a very short time span, then we are completely hedged, and I am glad to pay a little insurance premium for that every single quarter. So this is pretty much just an update, and it is me urging you to think a bit ahead instead of just thinking that everything will keep the way it has always been. Things do change, and this might be a period of time over the next 5 or 10 or 20 years where United States and the US dollar will be a lot less weak than we have seen before. That's pretty much all for now. Take care of yourself and your money out there, and of course, remember to comment in the comment section below so you are participating in the competition for these 1 ounce silver krugerand. That's all for now. I'll talk to you again very soon. Bye.